The market is currently closed. As of the last trading session on Friday, May 1, 2026 at 4 p.m. EDT, SoFi stock finished at $16.43, marking a solid gain of 2.05% or 33 cents. In the after-hours session, we saw continued movement with a slight uptick to $16.46 as of 8 p.m. EDT. While the headline says the stock recovered some ground today, the reality is that we are witnessing a massive disconnect between the company's fundamental performance and how the market is pricing its future. Most investors saw the recent 12% drop after earnings as a disaster, but the deeper numbers suggest the market might be misinterpreting a shift in the business model for a loss of momentum. This creates a fascinating tension because the expectations were set for an aggressive lending-heavy forecast, yet the reality is that the company is pivotally shifting toward a fee-based technology platform. This transition is usually messy for the stock price, but tends to be the hallmark of a maturing financial giant. If you look at the recent volatility, it is clear that high-volume institutional activity is battling retail sentiment. On one hand, you have traders using the Robinhood app and other investing sites who were spooked by a soft guidance segment, and on the other, you have institutional players looking at a 41% revenue growth and seeing a bargain. Let's get into the weeds of this recent movement because the daily swings have been aggressive. We started the week much higher, but the post-earnings reaction on April 29th was a gut punch, sending the price tumbling from the $18 range down toward the $15 mark before this latest stabilization. The trading volume has been massive, nearly doubling the daily average on the day of the release, which tells us that big blocks of shares were changing hands. This usually suggests that the weak hands are being shaken out while the long-term holders are reconsidering their positions. When you compare this to something like Nvidia stock or Tesla stock, which often move on pure hype or future promises, this company is moving based on hard interest rate expectations and the health of the American consumer. The macroeconomic pressure is undeniable, with oil prices fluctuating and the Federal Reserve holding rates steady despite internal dissent. Every fintech player is under the microscope. Investors are looking for any excuse to sell, and they found it in the slightly conservative outlook for the next quarter. However, the 10th consecutive quarter of profitability is something very few of its peers can claim. If we look at the broader sector momentum, the fintech space is currently in a tug-of-war. Traditional heavyweights like Fidelity and Schwab Intelligent Portfolios are competing for the same digital native audience it typically uses Interactive Brokers or SoFi Invest. The reality of the situation is that, while the market expected a straight line up, the transition to a more diversified revenue stream is causing some friction. For those of you tracking your own portfolios, how are you feeling about the fintech sector right now? Comment below how many shares of SoFi you currently hold, or if you are looking to add more at these levels. It's always interesting to see if the sentiment in the comments matches the price action we see on the screen. To understand why the stock is behaving this way, we have to look at the business model itself. This isn't just a student loan company anymore, and that is where the expectation versus reality gap is the widest. The general belief is that if student loan refinancing doesn't roar back, the company fails. The reality is that the financial services and technology platform segments are now contributing over $500 million to the top line. They are building an integrated ecosystem where once a member joins for one product, they stay for 3 or 4 more. This is what management calls the productivity loop. By using AI for automation in their backend and expanding into digital assets, they are trying to lower the cost of acquiring customers while increasing their lifetime value. It's a strategy that looks great on a spreadsheet, but takes years to reflect in a stable stock price. They are essentially trying to become the digital version of a Fidelity brokerage or a full-service institution, but with the lean overhead of a tech firm. Looking at past performance, we can see the scars of the last few years. The stock has been a favorite for those who enjoy online investing, but it has also been a source of frustration for anyone who bought near the 52-week high of $32.73. The recent drop to $11.64 earlier in the cycle showed just how much fear is baked into the valuation. But when you look at the Q1 2026 results specifically, the net income reached $167 million, which is more than double what it was a year ago. That is an objective win by any standard measurement. The tension comes from the fact that the market is a forward-looking machine. Investors aren't paying for what happened last month. They are paying for what they think will happen in 2027. Right now, the market is skeptical that they can maintain a 41% growth rate without taking on significant credit risk. For the person doing self-investing or looking for investment help, the current landscape is a lesson in patience. If you use the SoFi trading platform or even the Fidelity mobile app, you've likely seen the alerts regarding this volatility. The institutional activity suggests that the big players are watching the net interest margin, which actually improved to nearly 6%. That is a massive number in this environment. It shows that even while they are paying out high interest on savings accounts to attract deposits, they are managing their lending side with extreme efficiency. They added a record 1.1 million new members in just 3 months. To put that in perspective, that's like adding the entire population of a major city to your customer base every quarter. As we look toward the future outlook, several catalysts could change the narrative entirely. If the government decides to shift its stance on banking regulations, or if we see a surprise rate cut toward the end of 2026, the cost of capital for fintechs will drop and their margins will explode.
On the flip side, the risk remains that a recession could lead to higher default rates on those personal loans that have been driving growth. This is the ultimate expectation versus reality play. The expectation is that defaults will rise as the consumer weakens. The reality, according to recent data, is that their member base has a much higher average income and credit score than the typical bank customer. They are cherry-picking the best borrowers, which acts as a natural hedge against a downturn. In summary, the story of the stock is one of a company outgrowing its old reputation while the market struggles to keep up. We saw a strong close at $16.43, but the path back to the 20s will require more than just a revenue beat. It will require the market to accept that the era of being just a lender is over. The diversification into a tech-first financial hub is real, and the numbers substantiate that shift. While the short-term swings are painful, the underlying growth in members and products suggest a company that is successfully building a moat. The contrast between the disappointing guidance and the record-breaking net income is exactly where the opportunity or the danger lies, depending on your risk tolerance. Keep a close eye on the volume in the coming days, as it will tell you if the $16 level is a new floor or just a temporary pit stop. Whether you are using a SoFi robo-advisor or managing your own individual brokerage account, remember that the market rarely gives you a clear signal until after the move has already happened. The authority in this analysis comes from looking past the headline drop and seeing the structural improvements that are quietly making this a much stronger business than it was even 6 months ago. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, bell subscribe for more updates.